We'll look at the definition of option in textbook term. An option is a contract to buy or sell a specific financial product, also known as an underlying instrument. Option consists of strike price, expiry date. The value of the option depends on implied volatility, strike price, and the expiry date. There's many type and kind of option. There's two style of option, namely American and European. There's two kind of option, which is call and put, and there's three type of option: out of money option, at the money option, and in the money option. Two style of option, American and European. The key difference is a buyer of an American option has the right to exercise their right anytime before the option expiry, and the seller of an American option has the obligation to fulfill the right even before the option contract expire. Stock and ETF or exchange traded fund usually fall under American option. European option, on the other hand, can only be exercised when the option expire. Index option like RUT or SPX belong to European option. There is no distinct advantage or disadvantage between trading the option, but as a trader, you must always be aware. If you are buying an American option, know your right that you can exercise your option anytime you want, but of course, we do not want to exercise the option when there is still time value left. This will discuss later. If you are selling an American option, be aware of assignment. A buyer can exercise their option anytime, but in general, that do not happen often, especially when the option still has plenty of time value left. There is call option and put option. If you are buying a call option gives the buyer of the option contract the right but not the obligation to purchase the underlying asset. If you are buying a put option gives the buyer of the option contract the right but not the obligation to sell the underlying asset. We can also sell option and we will have an obligation to deliver the contract should we be assigned. We will look at more in depth into the rest of the option terminology as we progress through the course. Believe it or not, we have been trading option all our life. We have all seen discount coupon before. You have a coupon from a magazine that goes by the usual saying, a coffee maker for sale at $29.90. when the usual price is at $59.90. Often it comes with term and condition. While stock lasts and the coupon will expire by a certain date. This is a classic example of a call option. With the coupon, it gives you the right to buy the coffee maker, but if you do not drink coffee or already have a coffee maker, you are not obligated to use the coupon, and you can pass it to someone else or let the coupon expire worthless. The store owner, on the other hand, has the obligation to sell you the coffee maker for $29.90 as long as it has stock and the coupon has not expired. Let's look at one more example of call option before we move on to the put option. While happening to walk around a mall, you saw a painting that you have always wanted to buy. And it is a worldwide limited edition painting. And there is only 200 of such painting around the world. The price tag of $5,000 look reasonable to you. And you are all ready to make purchase when suddenly you remember your wife may be upset for you spending too much to buy such an item. We all know what happened in the end. So you decided to seek your wife's approval before you commit to buy the painting. You also find out from the shop owner that there is a potential buyer coming later in the day, and another few potential buyers will be coming in the next couple of days. After much discussion with the owner, you have both come to an agreement. You will pay the owner a $500 deposit, and he will not be allowed to sell the painting to other buyers within a week. And within a week, if you decide to buy the painting, you will pay the balance of $4,500. You have the right but not the obligation to buy the painting. You can choose to let the contract expire in 1 week time and lose the $500 deposit. This gives you ample of time to do research and seek approval from your wife. There may also be other reasons why you did not exercise your right. It could be financial reason, or after re-evaluating you do not find it worthwhile to purchase it for $5,000, or you may even have found a lower offer for the same painting for $2,000 on eBay. In that case, you would rather forfeit your deposit and purchase it from eBay at $2,000 but lost your $500 on the previous deposit. Why would the owner enter such a contract with you? First, the owner wanted to sell the painting for $5,000 anyway. The deposit more or less confirmed the deal. And if the deal is not true, the owner keeps the $500 deposit and he can again resell or market for $5,000 to the next potential customer. And if he did sell, his profit will be $5,000 plus $500 deposit from you previously. And imagine if all the potential customers come in and place a $500 deposit but let the contract expire. The shop owner will be happily keeping the $500 for many times. If you own a vehicle, you would have definitely purchased a motor insurance for your vehicle. The motor insurance premium is determined by the type of vehicle that you are driving. A high value car will definitely cost more to insure than a low value truck. Insurance usually have an expiry date, typically a year. Another factor that determines the cost of the insurance would be your driving habit. Are you a risky driver? Do you have a bad record in the last few years? All this will be determined by the insurance company and they will give you a quote for it. Purchasing the insurance gives you a peace of mind should you be required to claim it. Why does insurance companies sell you insurance? They do not sell you so that you can claim. But of course, you are entitled to claim. It is all about probability. The insurance company collect not just one but many insurance from different walks of people. While a minority do make some claim, but majority of the insurance is unclaimed and expire. And they can do it again and again every year. There you have it. In layman terms, what is a call option and put option, and what is the role of the buyer and the role of the seller. Options do not have to be complicated. I hope you enjoyed the video. Option can either be a call option or put option. Option has different expiry. It can expire in 1 week or 1 month or even a year or two from now. There is strategy to trade a short-term option and long-term option. You can be a buyer or seller of an option. In general, if you are bullish about the market, you will be buying a call option. And if you are bearish about the market, you will be buying a put option. But it can be a little complex if you are the seller of an option and you are bullish on the market, you can sell a put option. Remember, the seller of an option has the obligation to fulfill. If you are bullish, and the market did go up as anticipated, then your put option will be deemed worthless and you will win the game. Likewise, if you are bearish, you can buy a put option or you can sell a call option. In both cases, if the market drop, you win. It can be a little confused if you are new to option trading, but as we progress along and learn new strategy, things will become clearer. A stock option or ETF option is traded in a multiple of 100 shares. One contract of an option contract is worth 100 shares. If a particular stock option or ETF option is quoted as $2, then this option is worth $200. Taking $2 and multiply it by 100. If you are paying for the option, you'll be paying 200, and if you are selling the option, you'll be paid 200. When you look at the option change, you'll see different expiry. Option that expire in 3 days, 31 days, or 157 days, or some option even expire 600 days, which is commonly known as LIPS option. A short-term option expiry usually known as weekly option, with the exception of the third Friday expiry option, which is known as the regular option. Option that has more than 6 months to expiry is often referred to as a LIPS option. And as the LIPS option get closer to expiry, it becomes a regular option and new LIPS option will be introduced. Here is an example of an SPY option with 3 days to expiry. There is other expiry of course, but for discussion purpose I will just bring up this call option. With SPY trading at 208.91, we can see a range of options with different strike prices. From in the money option to at the money option to out of money option. More on this later on. If you look at the 206 call option, it is trading at $3.54 and multiply it by 100, this option costs $354. And if we look at the 215 call option, this option is trading at 0.02 and multiply it by 100, this option costs only $2. Should we go out and buy a few hundred of the 215 call option? Of course not. The 215 call option is way out of the money and the option expire in 3 days. There's very little chance of making money on this call option. Maybe 1 in a million, and you are better off buying a lottery ticket. The difference between the 206 call option and the 215 call option is the 206 call option is in the money and it consists of intrinsic value, whereas the 215 call option is out of money and it has no intrinsic value and only consists of extrinsic value, or what is commonly known as time value. Here is an example of the SPY put option with 3 days to expiry. The concept is the same as call option. There's in the money option and the money option and out of the money option. There is more to option, but as we progress through the course, the concept will be presented to you along with some strategy. Be aware of the pattern day trading rule. If you do more than 4 trades in a week, you are considered a pattern day trader. You are considered a pattern day trader if you do 4 or more day trades within a 5-day period, which also translates to you are only allowed to do 3-day trade in a 5-day period if you have less than $25,000 in your trading account. The rule does not apply to those that have more than $25,000 in their trading account. You will still be classified as a pattern day trader, but you are not restricted. For those that have less than 25,000, please keep track of your trade as you are only allowed to do 3-day trade in a 5-day period. Violation of the rule will depend on the broking firm. You may get warning or your trading account suspended. Repeat offender will get your trading account closed. How do you overcome the day trade limit? Having more than $25,000 will get you past the limit. Opening more than one brokerage account with different broker. You can have $5,000 and $3,000 in different brokerage account, and that will get you 6-day trade in 5-day period. Holding your trade for at least one working day will get you past the day trade. Day trade is referring to trade that is open and closed within the same day. Doing strategy that is not a day trade. Day trading is a different ballgame. I do not encourage day trading, and my strategy is not day trading. What exactly is a day trade? A day trade refers to opening a position and closing the same position on the same day. Some example of what is a day trade and what is not. Buying one 200 May call option on Monday at 10 a.m. and selling one 200 May call option on Monday at 3 p.m. This is a typical day trade. The next example, buy one 200 May call option on Monday at 10 a.m. selling one 200 May call option on Tuesday at 11 a.m. and buying one 200 May call option on Tuesday at 3 p.m. There is no day trade here, as the call option that you buy on Monday is closed on Tuesday. The reopening of the call on Tuesday is considered a new trade, so there's no day trade involved here. When will your trade be reset back? If you have done one day trade on Tuesday, you can do 2 more day trade for the next 4 days. The number of day trade left on Tuesday will be 2. Remember, you have done 1. On Wednesday, you have 2 day trade left, and on Thursday, you have 2 day trade left. And assuming on Friday, you do another day trade, then the number of day trade left is 1. On next Monday, you will have 1 day trade left. Next Tuesday, you will have 2 day trade, as the last Tuesday day trade is now being released back. Next Wednesday and Thursday, you have 2 day trade, and next Friday, you will get back your 3 day trade, since the last Friday day trade is now being returned to you. I hope the explanation on the day trade rule is clear. If not, you can always drop me a message and I'll be happy to help you out. Before we go on to the more complex option strategy, I would like to go through some of the thinking process when we pick a strategy. If you're bullish on a stock, there's basically a few options. We can go and buy the stock, and it will be a straightforward process. If you are right, you make money, and if you are wrong, you lose money. With option strategy, it will be more complex. You can be right and lose money, and you can be wrong and make money. That makes option a complex instrument to trade. But the good thing is, if you can play the game well, the odds could be in your favor. When you are bullish, you can choose to buy a call or you can sell a put. There is other more complex option strategy like debit spread, credit spread, diagonal or calendar. We will not be focusing on the complex strategy in this video. Not even on the selling or the put. Let's just focus on the buying a call as compared to buying the stock. The reverse is true. When you are bearish on the market, you could sell the stock, buy a put or sell the call, or execute some other complex strategy. Let's just concentrate on buying a call and just a simple call. Compare buying a stock with buying a call. When you buy a stock that is trading at $100, Your capital required is 10,000 because you are buying 100 share of the stock. You have unlimited downside risk all the way to 0. Although unlikely the stock will drop to 0, but you retain all the downside risks. You'll be earning dividend for the stock if there's any. Compare this with buying a 100 call option for $5. Your capital investment is only $500. For every option contract, it controls 100 shares. So $5 multiplied by 100 is $500. Your downside risk is only $500 even if the stock drops to 0. Assuming the option is held till expiration, your break even for the position is 105. The stock will have to go above 105 for you to make money. Anything less than 105, you are losing. On the option expiry day, if the stock closed at $120, the stock trader make $2,000 from a $10,000 investment. That is a 20% gain. The option trader make $1,500 from a $500 investment. That is a 300% gain. And if the stock closed at $100, the stock trader suffer no loss, but the option trader lost $500, which is a 100% loss. Finally, when the stock closed at $80, the stock trader lost $2,000, a 20% loss, and the option trader lost $500, which is another 100% loss. From the above, we can see there is advantage and disadvantage of trading with option. You can be using just $500 and double your account quickly, or you can also be losing 100% of your capital easily. Option offer you high leverage, and leverage is of course a double-edged sword. You can use it to your advantage, but if you misuse it, it can hurt you just as bad. Understanding how options work will be your key to successfully trading well with option. I hope you enjoyed this video. I'll be going more in depth into option as we progress through slowly. All option has a expiry, and in this example the expiry is 20th of May 2016. Option has a range of strike price. In the picture we can see strike price from 202 to 212. There's more strike price available, and this option expiry and strike price apply to both call and put option. We can have a call option that expire on 20th of May 2016 with a strike price of 202. We can also have a put option that expire on 20th of May 2016 with a strike price of 202. ITM refer to in the money, ATM refer to at the money, and OTM refer to out of money. In the money option has intrinsic value plus time value, also known as extrinsic value. It is very expensive in terms of the cost of the option. It is expensive because it has intrinsic value built into the option. At the money option has no intrinsic value, and it contains only time value. Because at the money option refer to strike price that is nearest to what the underlying market is trading, time value is the highest for at the money option. Out of money option is cheap because out of money option is far away from the underlying market, and the probability of the option expire being in the money is lesser as compared to at the money or in the money option. Therefore, the out of money option is always cheaper in terms of cost. With the underlying market trading at 208, the at the money call option will be 208. Remember that option buyer has the right but not obligation to buy the share, whereas option seller has the obligation to sell the share if the option become in the money. The lower the strike price, the higher the cost because the option is deep in the money. A 200 call option is selling for $8.50 because it has $8 of intrinsic value. Assuming the market remain at 208 when the option contract expire, the 200 call option will be $8 in the money and will be worth $8. So the buyer of this call option only lose 50 cents if the underlying market close at 208 on the option expiry date. Let's assume in another case, a call buyer is bullish on the market and think the market will go above 212 or even higher, but he does not want to buy the 200 call option as it is costing too much at $8.50, and if he's wrong in his prediction, he will lose quite a fair bit and he's not willing to take the position. After analyzing, he thinks the best choice would be to buy a 212 call option. Another seller come in and think the market is about to drop from the current level of 208 or maybe just go up a little bit more, but he do not think that the market will go above 212 on the option expiry date, and he felt that selling the call option with a strike price of 212 is a good bet. Both buyer and seller has entered a contest, and we will analyze what happened on different scenarios. On the option expiry date, the SPY closed at 208. The 212 call option will expire worthless and the buyer lose and seller win. If the SPY closed at 205, or in fact as long as the SPY closed below 212, the buyer lose and the seller win. Even when the SPY closed at 212, the option still expire worthless and the buyer lose and the seller win. When the SPY closed at 212.20, the 212 call option is worth 20 cents. So effectively the option is in the money and worth 20 cents and will be exercised immediately. However, remember, the buyer paid 50 cents for this option and is now collecting back 20 cents. So net position, the buyer is still down 30 cents and the seller win. In the last scenario, SPY closed at 215. 212 call option expired $3 in the money. Since the buyer paid 50 cents for the option and now made $3, his net gain is $2.50 and the seller in this case lose $3 on the option but have collected 50 cents in the beginning, so his net loss is $2.50. We can see from the above that in the first four scenarios, the buyer of the option lose almost 100% of the investment, except for the fourth scenario where the loss is slightly lesser. The fifth scenario, the buyer make 250% return on his investment, and that is what get people really excited, while the seller lose 250%. But do not start going to the market and buy a bunch of out of money option. Option is all about probability. The put option will be the opposite of call option. If you're unclear on the put option, just drop me a message or post on the discussion forum. If there's a need, I can do a video on it, but it is just the opposite of the call option. Put buyer has the right to sell the underlying market but not the obligation, whereas the put seller has the obligation to buy the underlying market should he be assigned. The value of an option is determined by various factors, but the main element is days to expiry. As we know, the shorter term option will always be cheaper than the longer term option. The strike price of the option, is it in the money, at the money, or out of money? The other element that determines the value of an option is volatility. If the volatility of an option is high, the value of the option will be expensive as compared to when the volatility of an option is low, the option will be cheap. Assuming that everything else remain unchanged, the day to expiry and strike price remain the same, The value of option can be changed because of implied volatility. If volatility is high, the option is expensive, and if volatility is low, the option is cheap. Volatility refers to how volatile is the market. A high implied volatility will often result in big range day, big movement, probably because there is uncertainty in the market. We have seen from the past, when there is a market crash, the volatility will always skyrocket. And if the market is on the uptrend, volatility tends to be coming off. Generally, when you are trading the stock market, by looking at the VIX, which is the futures contract, or VXX, which is the ETF tracker for VIX, you can roughly gauge if the volatility is high or low. A simple way is to look at the VIX or VXX chart and compare it to 1 month, 2 months, or 6 months ago. I will cover more on this as we go through the strategy. Stock and ETF will generally follow VIX, with the exception of those inverse ETF or commodity counter that is not correlated to the stock market. We have a basic understanding of volatility. Do we want high volatility or low volatility? That will generally depend on what position you are having. If you are long option, you of course want a high volatile market as the trading range will be big. But if you are short option, you will want low volatile market as the trading range will be small. Another question to ask is, do we buy when the volatility is high or low? Or do we sell when the volatility is high or low? We know that high volatility, the trading range is big, but the option is expensive and the volatility may drop. How about buying an option when the volatility is low? Although the option will cost cheaper, but the trading range will also mean that the stock will not have any big movement and the volatility may stay in this range for a very long time. All that I have discussed is all valid questions, and when we look at different strategy, we can learn to apply the concept that we learned in this video. Option trading, although complex, but it offers a 3-dimension trading when used it correctly. Let's assume that we are bullish and the market is trading at 206. We are bullish on the market and we are going to long some call option. The question then will be which expiry to choose and which call option to buy. The shorter the expiry, the cheaper will be to own the call, while the longer term option will be more expensive to own. This makes sense as the short term option has only X amount of days for the market to move in our favor to our position, while the longer term option will give us a longer time for our position to work out. Therefore, the longer term option will always be more expensive. However, we need to realize that cheap and expensive has another meaning in option. While the short term option is priced cheaper than the longer term option, but the cost of owning a longer term option will average out to be lower in cost. A 7-day option may cost $38, but a 1-month option will cost $110, and the 260-day option will cost only $760. The 260-day option has 37 weeks to go, and if you were to keep buying 7-day option for $38, you'll end up paying more than $1,400 instead of paying $760 if you choose to buy the long-term option in the beginning. As in real life, the longer we decide to pay for our insurance, the cheaper it costs, whereas any short-term insurance policy that you buy will always cost more. This works the same way in option market. And choosing a expiry day is not the only consideration. We have another key element to consider. Do we long a out of money call, which is cheaper, or do we long a at the money or in the money call, which is more expensive? Different call will have different result. While all positions do have a bullish bias, but choosing a different call strike will have a totally different end result at the end of the day. In one of the previous video, I did present to you that if an option expires at 206, the out of money and at the money option will be worthless, while only the in the money call option will still have some value. And it depends on how much you pay for the in the money call to determine if you make or lose on this position. If the market were to go down, then all the options will lose money. The in the money option will be losing the most as it is the most expensive option. Do we always go for the cheaper option? Of course not. Option is all about probability. We are in a game of probability. The cheapest option will not always be the best bet, while the most expensive option may not always be the lousy bet. Just for simplicity purpose, we will just compare between two expiry, the 7-day and the 30 days expiry. Take a look at the different expiry and different strike price. Which expiry do we choose? And which call do we buy? Further assuming that we have $1,000 to invest in this long position, do we buy 26 of the 210 call option that expire in 7 days for $988? Or do we buy 2 of the 205 call option that expire in 30 days for $820? Or maybe we should consider buying 1 of the 200 call option that expire in 30 days for $780. All this is a valid assumption, and all 3 calls will have different results depending on where the market expires. Ultimately, which expiry and which call you choose depend on what is your risk profile. Buying 26 out of money call that expire in 7 days will be a rather speculative play, as the odds will not be in your favor and the probability of the option expire in the money will be slim. Also, how bullish are you on the market? And when do you expect the move to occur? Do we expect the move to happen in a few days time? If we do expect movement in the near short term, probably due to a news or earnings play, then buying a 7 days option is okay. What I present in this video is only buying a simple call option, and this will just be the beginning. There is more complex strategy if we are bullish. We do not have to stick to just buying a straight call. We can do a spread, and there's various kind of spread that we can use. So welcome to the world of option trading, and let the journey begin. Let's now for a moment consider the position of both option buyer and option seller. Option buyer has a limited risk and potentially have an unlimited reward. The downside is that the trade is a debit trade to initiate, and directional must be right for the position to make money, with the exception of a straddle trade, which we will discuss in another video. If you buy a call, market must go up for you to make money. And likewise, if you buy a put, market must go down for you to make money. That is a major hurdle for trading. No matter how advanced technology is, we always fall upon trying to predict the next move, and my belief is nobody will ever be able to predict market direction correctly in the long run. Time decay is always working against you when you buy an option. Every day your option is losing a bit of value, and if the market did not move fast enough, your option will eventually expire worthless. It is like buying a lottery ticket. Option seller has a limited reward and unlimited risk if the position is a naked position. It is a credit trade. The option seller gets paid to initiate the position. Option seller is like the house of a casino, an insurance company. Most of us will never be able to own a casino or be an insurance company. But with option selling, we can be on the other side of the trade. One important element is that the time decay is always on our side. As long as the market did not have any major movement, the option that we sell will eventually expire worthless. Even when the market is moving against us, we may still be able to come out ahead. A stock is trading at 200. Option buyer is bullish on the market, but instead of buying the stock at 200 for 100 share, that will cost $20,000. Option buyer can buy a 220 out of money call for $100 that expire in 30 days. The risk is only $100, while the reward is unlimited as the stock has no limit on how high it can go up. But the question is, how realistic is the stock going to trade above 220 in the next 30 days? The market maker has already defined what that call option is worth. If the stock is very likely to trade above 220, then the option is going to be very expensive. Market makers do not sell you the option for you to make money. They sell you the option so that they can make money. Probability, I cannot stress this enough. Option is all about probability. We can see this chart for a better illustration. The option buyer is bullish and the market is trading at 200. Option buyer decided to buy an out of money call for $100. What is the probability that the market will trade above it? And anywhere from 220 or in fact 221 and below, this option buyer will lose money. Back to the same position, but let's take the stand from the option seller side. The option seller is also bullish on the market, but instead of buying the stock or buying the out of money call, which both of it is a debit trade, the option seller decided to sell an out of money put at a strike of 180 for $100 that expire in 30 days. The reward is only $100 while the risk is all the way to zero if the stock ever dropped to zero. How likely is the market going to drop more than 10% in a month time? And if the market stay above 180, this option seller will be laughing his way to the bank, and he can do it again and again, next month, next year. This is how the casino works, and this is how the insurance company operate. Let's look at this chart for a better illustration. The option seller is bullish and the market is trading at 200. Option seller, instead of buying the stock or buying a call, decide to sell an out of money put that has a strike price of 180 for $100. If the market stay anywhere above 180, the option seller win. The stock is trading at 200. Even if the stock drop to 190, the option seller still win. Remember that I mentioned before, you can be wrong but still make money in option. Are you an option buyer or are you an option seller? I'm more geared towards option selling, so the strategy I presented will be on option selling with the exception of a few trades. Occasionally I may do a debit trade for a directional bet or do a straddle trade, but for the most part I'm usually selling option. Go through this video again if you're unclear. In option trading, there's a lot of elements and factors that affect the option price. Some of the option grid is important and will be useful in our trading. There's 5 different grids: Delta, Gamma, Theta, Vega and Rho, which is the least important and we'll skip that. All the grid is different. A 3-day expiry call option will have a totally different set of grid as compared to a 10-day expiry call option. A screenshot taken from Thinkorswim platform showing the call option that expire in 3 days. And these are all the grid: Delta, Gamma, Theta, Vega. And here's another screenshot for the put option, showing all the different grid. So different strike price will have a different set of grid. And this is a 3-day expiry. If you look at the 10-day expiry or 30-day expiry, then you have a totally different set of grid again. Delta is the most commonly used. It measures how much the theoretical value of an option will change if the underlying stock move up or down by $1. Call delta range from 0 to 1, positive, and put delta range from 0 to -1, which is negative. For instance, ABC stock is trading at 48. A 50 call option with a value of $2 and delta of 0.45. If ABC rise to $49, this call option will rise from $2 to $2.45 because the delta is 45. Likewise, if the ABC were to fall to 47, the call option will drop in value from $2 to $1.55. A 50 put option with a value of $3.75 and delta of negative 0.55. So if the ABC rise to 49, the put option will fall from 375 to 320 because the delta is negative 0.55. And if the ABC stock were to fall $1 to 47, then the put will rise from 375 to 430 because the put delta is negative 55, 0.55. So option buyer want a high delta, whereas option seller want a low delta. In the money has high delta, out of money has very low delta. Gamma basically estimate how much the delta of option change when the price of the stock move $1. Long option has positive gamma and short option has negative gamma. For instance, XYZ stock is trading at 48. A 50 call with delta 0.45 and a gamma at 0.07. If the XYZ were to raise to 49, the delta will change from 0.45 to 0.52 because the gamma is 0.07. So you'll add 0.45 plus 0.07, that is 0.52. Likewise, if the XYZ were to fall $4 to 47, then the delta will change 0.45 minus 0.07 to 0.38. The opposite will be true for the put delta. The gamma is the highest at the money strike. In the money and out of money, the gamma will be progressive lower. Theta, which stands for time decay, estimate how much the theoretical value of option decreased when 1 day passed without any movement in either the stock price or the volatility. For instance, ABC 50 put at $3 with a theta of 0.15 and 20 days to expiry. If all else remains unchanged, the ABC put will drop by 15 cents to 285 after 1 day and further to 270 after another 1 more day. Option buyer has a negative theta because they are paying for the option, and option seller has a positive theta because they are earning the time decay. Watch the video on the time decay, as this is just a rough guide of the theta. In the time decay video, I have shown that time decay of option is not linear, so it does not work this way after 15 days, the option will drop 50%. No, it doesn't work this way. So please take your time and watch the video on the time decay. Vega estimate how much the theoretical value of option change when volatility change 1%. Long option positive Vega and short option negative Vega. For instance, ABC 50 call at $2 with a Vega of plus 20 plus 0.2 and volatility is at 30%. If volatility rise to 31%, then the ABC call will be worth $2 plus 0.2, which is 220. If the volatility were to fall to 29%, then the ABC 50 call will be worth $2 minus 0.2, and that is 180. Although it may seem that there is a lot of information at this point, but as we go through the course, you'll learn that I only use selective grid and information for my trade. I hope you enjoyed the video. Time decay of option is not linear. We need to understand this, and it is very important for both option buyer and seller. A 1-month option costs $1.50 and a 3-month option costs $3.50, while a 10-month option costs $8. This is a typical price of option chain. Let's focus on the 10-month option. After 1 month has passed, the option has 9 months to expiry. How much will it worth? Does it drop 10% of it and fall to $7.20? Of course not. We are assuming that everything remain unchanged, the stock price remain unchanged, and volatility remain unchanged, and the only thing changed is the expiry. After 7 months has passed, and the option left only 3 months, does the option drop 70% in value? No. Look at the previous code. We can see that the 3 months option costs $3.50. So the 10-month option, after 7 months, it will drop slightly more than 50%, but not 70%. The longer the option, the less time decay it will have. All options decay, but the longer option decay at a much slower pace than the shorter option. We can see from this time decay chart, the option decay very little in the beginning and progress rapidly towards the end. In fact, if you compare a 1-month option and a 1-week option, the decay will even accelerate much more for the weekly option. Regardless of what strategy or what type of trader you are, whether you are buying option or selling option, you must understand how the time decay affect your position. As a rule of thumb, always remember, longer term option will always decay slower than the shorter term option. And the time decay is not linear, but accelerate towards the end of the life of the option. The straddle price of an option is perhaps the most important factor that I look at when I'm trading option. What is a straddle? Straddle basically refer to at the money call and at the money put option. The straddle price basically add up the two together. For instance, a market that is trading at 206, a 5-day at the money call option is 130 and a 5-day at the money put option is 131. The straddle in this case is 261. You can either buy a straddle or you can sell a straddle. The straddle price is also one standard deviation of the stock. Market is trading at 206. 5-day to expiry straddle cost 261. The upward band is 206 plus 261, which is 208.61, and the downward band is 206 minus 261, which is 203.39. So market is expected to trade within this range, 203.39 to 208.61 based on all the current factor of the stock for the next 5 days. 68% of the time, market will fall within this range, which is also one standard deviation. There is of course 2 standard deviation, 2.5 and 3 standard deviation. The longer term straddle will cost more than the short term straddle, which is obvious as the market has more time to move. 5 day at the money straddle costs 261, a 30 days will cost more than that, which in this case costs 620, and the 600 day at the money straddle costs $37. That is because for 600 day the market has more time to move as compared to a 5 day straddle. It is not important how the market derives the value, we just have to know it and use it to our advantage. Market maker exists to create liquidity to the market. Is the market maker always right? No, but usually they are right and they won't be too far off. If the market is expecting a big move in the next 5 days, a $5 move, then the straddle will not be pricing at 261, as everybody will rush in to buy it since the market is expecting a $5 move. Likewise, if the market is expecting a $1 move in the next 5 days, then nobody will be buying the straddle at a cost of 261. Everybody will be looking to sell the straddle, as the market is only expecting a $1 move. Just by looking at the straddle price, we can know a lot of information and start building strategy around it with this information. The option market has been known to be very efficient in the pricing. The straddle price that we see is what the market has priced into it. I'll be going to discuss this again when I go in depth into the strategy.